So this all started, if you have noticed, that any books that we read or find about the subject of trading or technical analysis, essentially they all come from this main country of United States of America. That's mainly because of the fact that this is one country which is the capitalist prime, and all the exchanges, the oldest exchange, the oldest futures and options exchange, everything came from here, the entire idea of capitalism, right? So it was back there before the 1900s, even before the 1900s, that a person named Charles Dow, right? He was the founder editor of the Wall Street Journal. Anyone who knows what is a Wall Street Journal? The Wall Street Journal is one of the most reputed periodicals, magazine in the field of financial markets. Now, he was a founder editor, and what he did in those days, he made two averages. One he called, okay, he didn't call it. One was the industrial average, okay, and the other one was the transportation average. So essentially, what he did, he took 30 companies which were mainly into industrials, and 30 companies who were mainly into transportation. And what he used to do is he used to track them every day, closing prices. He used to add it up and create an average. End of the day, what he got was essentially a number, an average. And what he did after that, he took a chart, a two-dimensional plane, where on one axis he got time, the other axis he plotted price, and what he got was essentially dots. These numbers, ratios, are essentially dots. And eventually, when you join these dots, you get some kind of a graph going up and down. We can say that this was probably the first chart or graph that we have probably come across, thanks to Charles Dow. That is charts of indices, charts of averages. Now he calculated them, he plotted them, he observed them, and he came out with tenets, few observations. These are the 6 main tenets of the Dow theory. Now this theory can be ancient, this theory can be pre or computer age, etc., etc. But still, the observations that was made by Charles Dow and put in these 6 tenets still holds really good, even in today's days, even when we have algo trades and almost over 30% of Nifty's volume is taken by computers. Let me ask a question. Why do you think so that even after 120 years, the observations made then, to a lot of extent, still holds true? What do you think? Why do you think that these observations that we are going to talk about still holds true in today's day? Fear and greed. That's true, Abhiram. Let's get into that fear and greed thing a little more extended way. This holds true because of, let's say, if I tell you that the oldest exchange in Asia is the Bombay Stock Exchange. The Bombay Stock Exchange is around 142 years old, right? So we are essentially looking at a market, looking into an exchange which is over 100 years old now. And there were people 50 years back, let's say we go back minus 50 years. And obviously there was an exchange, there was a market where people used to go physically, and outcry method, they used to shout out and trade, right? Now we have today where you don't need to go anywhere, you have it on your phone or on your laptop and you're trading. And let's say 50 years ahead, what will happen, we can discuss little later. Try and understand something, that with the passage of time, the way that we have been trading has changed, but trading per se has not changed. The way we trade has changed. What we trade has changed. More and more instruments have come and gone off the market. We have seen huge bull markets and sheer panicking bear markets. But the fact that we trade, the fact that we are opportunists, the fact that we like to speculate, this fact has not changed. This is mainly because the way I see it is content versus context, or internal versus external. What is it? Well, if you can see that the externalities of trading have completely changed. Earlier, people used to shout and trade. Then people started punching orders through technology. Now you can do it on your phone, just a few taps on a device on your pocket, you can trade. So externalities have changed. But then you look into what can happen 50 years from ahead. The way I see it, not even 50, another 10 to 15 years, is we will probably not even have to punch or our trades, or even have to tap our smartphone or tabs to trade. Probably we'll have chips inside us, or we'll be plugged into an intelligence where our thoughts will be read, and if we think and we decide, our mind decides that yes, Reliance is a good buy at 1000 rupees and I want to buy 10 shares of Reliance, this thought will be read by the computer and it will be triggered, and the trade can happen through the broker. What I'm trying to say is probably there will be no actions required. The very thought of us can actually take care of the actions. I think it's very much possible in the future. What I'm trying to tell you is note that how the externalities have been changing throughout, and it's a constant thing. This change is a constant thing. What has never changed is the internalities, or the internal aspects. And this is what Abhiram said rightly, that at the internal level, those people 142 years back or 50 years back were led by greed and fear. Today, you and me were doing this course and we participate in the market every day. And our objective is to generate some passive income, active income, to be free from what we are doing now, to have that kind of flexibility to go anywhere and trade from there. But the internalities of two big emotions of greed and fear, they were there 50 years back, they are still here between you and me, and they will still be there 50 years ahead also. Even if machines have taken up over 30% of our exchange volumes, those machines are essentially automating the execution. Those machines are fed by a certain kind of rules, and those rules essentially come from us. So at an underlying level, those systems, those parameters, those algorithms also have greed and fear, because they are created by us, right? So because of these two things, which Abhiram rightly said, of greed and fear, we will have bull markets and we will have bear markets. This kind of cyclical movement of the prices of exchanges worldwide, of asset classes worldwide, will never change as long as greed and fear is there. The way we trade has changed, will change, and we have to be up to it, right? That's the reason why, observations made by Dow theory, by Charles Dow in those years, still hold true. He did not say that I am coining the Dow theory word. It's his followers who later on came with the Dow theory. I find one book really nice if you want to read about the basics of this theory. It will give a good understanding of the structure of how the markets actually has evolved and works. And this is the book I'm talking about. Robert Ray, this one. It's not very clean. The name of the book is The Dow Theory. Robert Ray, not RGEA, it's RHEA. Robert RHEA. Yeah. This is one book that we can look into for Dow theory.